you're anything like me, you probably look at all sorts of candlestick charts, wishing you knew that you could make sense of them, wanting to live the life of someone who trades professionally. The thing is, it doesn't have to be some fantasy that you have. In this video, I'm going to show you exactly how to start day trading in 2023. Day trading is basically the act of buying and selling shares on the stock market. You can do this in multiple different ways, whether it's just buying shares, you can short shares, you can also buy options or even futures. This is important because you're essentially buying shares of a company because they're public, which means if you buy it, price is going to go up, and if you sell it, price is going to go down. All the way that stocks trade is simply based on the fact of buyers and sellers. There's more people buying, stock is going to go higher, and you'll end up making money. If the stock goes lower because there's more people selling, then you're going to lose money. There are a lot of benefits and risks according to day trading. The biggest one is that you can make a lot of money, but you can also lose a lot of money. The downside is that if you treat it like a gambling or a casino, then you can end up losing a lot of money. This happens very common to a lot of new people who get into day trading. So you definitely want to make sure that you have very good risk management. There are a lot of different types of day traders as well. There are people who like to get in and out within a few minutes or maybe even a few seconds. Those are typically called scalpers. There's a few other ones that like to do it throughout the entire day. I like to focus on both. The last part is also swing trading. So what you can do is get in and get out the next day, or get out, maybe a week later, a few weeks later, whatever it is, that would be considered swing trading. There are a lot of tools and resources that you want to use for your trading. Now, there's two different types of analysis you can do. There's fundamental analysis and technical analysis. Fundamental analysis is looking at the history of the actual stock itself. So looking at the PE ratio, looking at the dividends, how the company actually works in terms of its profit, its loss, all of that stuff. The other side that a lot of day traders stick to is technical analysis. This is strictly looking at the charts, coming up with a strategy solely based on the actual price of the stock itself. The most common tools that you're going to need are simply having a broker so you can execute the trades, and a charting platform such as Thinkorswim, TradingView are the ones that I like to use. Other brokers you may want to consider are Tastyworks, E-Trade, TD Ameritrade. A lot of these are really solid brokers, and you can execute pretty easily on them. Now, when it comes to actually trading, having a very well-defined strategy is very important. If you have a well-defined strategy, meaning specific criteria for all your entries, your stops, and your targets, you're going to have a much better edge in the market that will allow you to make money over time. The key elements to having a successful strategy really is based on a few different indicators. You can look at price, you can look at volume, you can look at RSI, MACD, trend. There's a million different things you can look at. But the most important part when it comes to having a successful strategy is simply having confluence, which essentially means getting a lot of things to align together. So when trend lines up with price lines up with a support zone, or whatever it is you're looking at, when you get a lot of things to come together, that gives you a much better edge that price is going to move in a certain direction. One of the biggest strategies that traders like to use is simply called support and resistance. A lot of times price will like to go to a certain level, stay there for a little bit, and then end up coming back down. And when it goes back to that same level, it repeats the process. That would be a simple resistance zone, and the same thing goes for the bottom with a support zone. By identifying different support and resistance zones or levels, you can simply draw them on your chart, wait for price to approach it, and then take a trade in a position that you're assuming price is going to reverse in the other direction. Another strategy that a lot of people like to use is called bull flags and bear flags. Those are essentially a very common, simple strategy where you just wait for price to make a big move in one direction, consolidate for a few minutes or a few hours, and then you take the breakout expecting price to continue in that direction. This works really well because a lot of times price just continues going in a certain trend. It will go up, it will consolidate, or go down for a little bit, and then end up making another leg higher. If you're able to identify these patterns and identify these trends, you can take advantage of the opportunity and make a lot of money. One of the biggest parts about day trading is the psychological aspect behind it. You'd be surprised how many people struggle with the emotions that come with day trading, because you can make a lot of money and lose a lot of money very quickly. There are a few different practices I use to manage my trades. I'll go ahead and share them with you. The first one is going to be setting OCO orders. These can get a little complicated, but in a small sense, it essentially means you're able to get in, set your stop loss, set your target, and then walk away. This way, you're not even looking at the charts while you trade, which makes it very easy and very prone to not having any emotions while you're trading. You can simply get into a stock, say if price gets down to this level, I'm going to get out for a loss. Price gets up to this level, I'm going to get out for a gain. You can set that automatically so you don't even need to do anything else once you get into the trade. Another big practice that I like to use when it comes to trading is moving my stop loss. A lot of times when you're trading, you want to have a stop loss where in case you're wrong and price goes in the opposite direction, you're protected and you don't end up losing all of the money in your account. Now, there are a lot of times where you'll get into a trade, price will go in your favor, and you want to be able to protect those gains that are currently in your favor. You can do this by simply moving your stop up as price ends up going in your favor. So if you get in here, and and then price is all the way up here, you can go ahead and move your stop loss up to your break-even point so it's a risk-free trade. This is a very common strategy that a lot of traders like to do because it allows you to reduce your risk and also make it a very much more emotionless trade. If you like this one, make sure to subscribe, hit that bell so you know every time I post. Thanks for watching, and I'll see you in the next one.